Hello traders, you're welcome back to the Forex Geek channel. In this particular video, we are diving into one of the most popular reversal patterns in trading. All right, and that is the inverse head and shoulder pattern. Okay, so the inverse head and shoulder pattern is used by traders across different markets because it often signals a potential shift in trend direction, making it an essential tool to understand. So let us start with what the inverse head and shoulders pattern actually is. All right. Now, picture a chart where the market has been moving down. All right. There has to be a downtrend. Okay. Downtrend is like the first step. Okay. So the market has been moving down, and then suddenly price action forms three distinct throws or lows. That is the first shoulder, the head, and the second shoulder. So there are going to be three distinct lows. Okay. The first throw forms the left shoulder, followed by a deeper low, which becomes the head. And finally, another throw forms that's similar in height to the first. Remember that the second is always lower than the first and second. And the first and second are almost around the same, level. They might not be exactly at the same level, but, close to the same level. All right. So that creates the right shoulder. Across the top of these throws is a resistance level we call the neckline. So when price breaks above this neckline, traders often interpret it as a sign that the downtrend may be coming to an end and a new upward move could begin. Okay? Now, breaking this down further, the left shoulder reflects the market attempting to continue lower but finding temporary support. The head shows sellers pushing harder to drive the market to a new low, but buyers eventually step in again. The right shoulder forms when sellers try once more, but fail to push the market as low as before, showing weakening momentum. The neckline connects the highs between these throws. You can see the two highs between these throws is what forms the neckline. All right. And the break above this line is where many traders look to confirm the reversal. So how do you actually trade the inverse head and shoulders pattern? Step one is identifying the pattern clearly on your charts. Now, the reasons why I'm coming here to look for examples is because, one thing with patterns like this, you might not always find them. All right. You're going to find those patterns likely, right? You would likely come across them maybe at some points or not. Yeah. But there is no guarantee that you will always find a pattern. I think I recently found a pattern that is, I think, a head and shoulders or like a head and shoulders. For example, this is a live chart, right? You can see that we had but this is, we are talking about inverse head and shoulders this time, okay? But I just wanted to show you something. So we had the head here, right? And we had shoulders. Can you see? So, but this particular example, you can see we're having our neckline somewhere around here. In this particular example, if we are going to be using this as our head and shoulder, you can see head and two shoulders. That means for this example, it's going to be a bearish breakout that we'll be watching out for, right? And we need to see price come to break this neckline. But it seems as if the bullish momentum is getting strong, and it's like this pattern has already changed, because now we see price breaking above this particular. But you know, I'm just deviating a little bit, okay, showing you that actually you can find these patterns on the chart, but you might not see them all the time, okay. So in order to save time and, you know, looking for an inverse head and shoulders, you know, we can just come here to find examples, all right, to save our time. So you need to first of all identify the pattern on your chart, okay. You identify it clearly on your chart. You want to see a clear left shoulder, you want to see a clear head, all right. Okay, in this case, this is our left shoulder, this is our head, and this is our right shoulder, all right, forming in a downtrend. This example that I showed you here was an uptrend, right? That's the reason why this is a head and shoulders pattern. Head and shoulders is for, you know, an uptrend, and then you are looking for a breakout to the downside. But inverse head and shoulders is for a downtrend, and you are looking for a breakout to the upside. Okay, so you watch the neckline carefully. The neckline acts as your key level. Traders typically wait for a clean breakout above the neckline before considering an entry. Some will even wait for a retest of the neckline after the breakout to confirm the move. Now, the step 3 is risk management. Many traders place their stop loss orders below the right shoulder. All right? Or below the head, depending on their approach to risk. This way, if the pattern fails, they limit their exposure. Step 4 is setting a target. A common method is measuring the distance from the neckline down to the head, and then projecting that distance upward from the neckline breakout point, okay? So this gives a potential target area for the move. It's also important to note that not every inverse head and shoulders pattern plays out perfectly, okay? False breakouts can happen, which is why patience and confirmation are key. Combining this pattern with other tools such as volume analysis or support and resistance zones can help strengthen the trade setup. Understanding and applying the inverse head and shoulders pattern can give you more confidence when analyzing market reversals, right? It's not about predicting the future perfectly, but about recognizing signals that suggest a change in market behavior. So if you found this explanation helpful, make sure to click the like button and don't forget to subscribe for more trading strategies, technical breakdowns, and market analysis. See you in the next video.